Put this on from the beginning. All right, so I don't want to take too much of anybody's time, so I'm just going to start this up where we're at here. So thank you for joining us. This is what we are calling Thirsty for Knowledge Thursdays. We're doing this webinar. This is the Aries Foundation for Financial Education. This week, we've titled this one Sell in May and Go Away, which is really a COVID-19 story about what's going on the financial markets, or more to the point, just really what is Wall Street doing through this pandemic, and where do we see things going from here? So a little bit about us. That's me. I'm Tom Alessi. I have been in financial services for more than 20 years. I have a fiduciary license. I also carry a 24. That's a principal's license. So I'm held to not only fiduciary standards, but oversight standards. My area of expertise and what I deal in is more of the wealth advisory, the investment side of things. I'm going to bring Craig on in a second, and Craig will introduce himself. The only thing I will say with that picture is obviously that was at a time when I was a lot less hairier than I am now, and cannot wait for my barbershop to open soon so that I can get myself a haircut. But Craig, why don't you come on and introduce yourself?
Sure. I'm Craig Richardson. I'm 16 years in the financial services industry, 6 and 63. And my strength that I bring to this is in the financial planning aspect, helping people and businesses to come up with financial plans and have a better understanding of their finances and have more efficiency in their financial plans.
Thank you. All right, so disclosures before we start. This presentation is meant to be purely educational. This is the expressed opinions of your presenters. It's not intended to be taken as any type of advice, investment, legal, tax, or otherwise. The Aries Foundation for Financial Education is a nonprofit. We're not affiliated with any broker-dealer. We're not securities related business, and we are not a registered investment advisor. We always recommend that if you do have questions, you seek out a professional to help with that. A little housekeeping before I get started. As you'll notice that all of the cameras are off. We do that intentionally because we like to make sure that the focus is on the screen and on the presentation itself. You've probably been on other webinars. Sometimes it can be distractions if there are cameras on. Consequently, all of the mics are also muted for any of the participants. There is a chat box. We do ask that if you do have questions as we go along, we will get to them at the end. We're not able to dive into them as we go through this, but we will bring the questions up at the end. If we can't get to an answer at that time, we will reach back out with them and let you know and get that answered for you. But just take advantage of the chat box if you do have a question that comes up. All right, so we are going to pour ourselves a glass here. I will say this as sort of a start with it, that Craig and I take financial education very, very seriously. We take financial well-being very seriously. We hopefully, however, will never take ourselves very seriously. So we like to try to give you some information, have it be informative, but we also want to be a little light and enjoyable as we do that. So we're going to ask you to pour a glass along with us. In my case, I'm having Easy Miles. That's by Magic Hat. They're out of Vermont. You can find them in any local establishment or at a retailer. Easy Miles is a hazy IPA with notes of lemon, orange, and mango. Craig, what do you got on tap?
Well, I'm going to be our designated driver, and I'm going to be drinking an IBC root beer. They've been in business since 1919. Naturally and artificially flavored, a 12-ounce bottle.
So feel free to join along with us. Pour yourself a glass. For those of you who choose not to or who cannot imbibe, pour a glass of your favorite beverage to quench your thirst along the way. In my case, if I was doing that, I am partial to Arnold Palmer's, which are half iced tea and half lemonade. So I'll raise the glass and say Skol, which is to good health. All right. So the Aries Foundation for Financial Education, this is just quickly on us. You can visit the site at ariesfoundation.org. Again, we're a nonprofit. Our whole mantra is to try to give people information, education, help them have a better relationship with their money. That is what we're trying to do outreach, trying to get people to have a better understanding, be better emotionally with their money. But you can visit the site, learn a little bit more about us and what we do. And with that, I am going to jump into sell in May and go away. So, and it says, how does this relate to COVID-19 and where we are today? So, sell in May and go away. What does it really mean? It's a pithy little saying. It's catchy. It's fun to say. But is there anything really behind it? And there's a couple of different takes on, where the adage came from, whether it goes back all the way to old England and then Wall Street just co-opted it. But there really is a basis behind sell in May and go away. And the adage, the basis, the premise behind it is that if you did a comparison of month by month returns and then started to sequence those months together, and then did them on a year over year over year basis. And in this case, the markets did it from 1950 to 2013 and looked at it, a pattern emerges. And what the pattern says is that the 6 best performing months of the year are November to April. And that the worst performing 6 months of the year, even on a Thirsty Thursday, we don't have to do too much to think, that is May through October. So the way the premise goes is the premise says, hey, come beginning of May, you should liquidate, maybe take some profit, pair, do a little bit of portfolio reallocation, sit that money on the sidelines in cash, and then come back into the market sometime around the middle of November. That's the premise. That's what sell in May, go and go away refers to. A couple of things with that. There is nothing that says this is the reason that it occurs. It's just a pattern that exists. It doesn't always work. In fact, if you go back over the last 20 years, and I'm using from 1998 to 2018, so those are my 20 years, not the 2019 in that. But so past 20 years, if you took $10,000 in 1998 and invested it in the S&P 500, at the end of the 20-year time period, you'd have, it's $26,812. If you did the sell in May and go away over that 20-year time period, you'd have $27,700. It's not much difference. You didn't really do it. The principle, the premise isn't really that big of a difference. But why do we bring it up here? Why do we say, hey, sell in May and go away? Because it's more about the fact that we are in May, and this is the pandemic and where we are with coronavirus, and how is this all sort of applying to the markets and where we are right now. So first, to do that, we're going to talk about some of the terms that are being thrown around during COVID-19. And some of these, the first two, a market correction and a bear market, refer to declines that are occurring in the market. So a market correction means the market is down 10% from the 52-week high. A bear market is down 20% from the 52-week high. And you've probably heard this, certainly in March and in the beginning of April, you heard this thrown around all the time. The market was, we're in a bear market, we're in a market correction, going on back and forth on an almost daily basis. You were hearing this. Here's the problem with it as far as how it applies to coronavirus. The 52-week high occurred on February 19, 2020. For most investors, unless you actually looked at your account on February 19th or February 20th of this year, you didn't see it. What you saw was where your statement, where you were at the end of last year, 12/31, and then where you were on 331 at the end of the first quarter. You really didn't see the 52-week high, more than likely, in your accounts. So what Craig and I do is we talk to everybody about where we are year to date. Where were we at the end of 2019 and where are we now? And really, when you look at the market today, the S&P 500 is not in a correction year to date. It was just closing before I got on here, but it was down, down year to date about 8.7, 8.8%. So not at that 10% correction marker. The 1-year return, 12 months from last May to this May, is up. It's in a positive. It's only up 3.5 or 3.66%, but it's still in a positive on a 1-year return. So those are some of the things to be looking at and not thinking about this from the 52-week high. And my goodness, we are still in a correction from the 52-week high because the market, the S&P is down more than 10%. But that's from February 20th. The recession, that conversation started occurring in March. And you've got to have 2 consecutive quarters of negative fall in the GDP. The GDP there is the gross domestic product. But because of the quarantine, that we knew the first quarter was going to be down, the projection was already that the second quarter was going to be down. So we went into a recession without even getting, we haven't even gotten into the recession because you don't get into it until the end of June. But we're in a recession because we knew there would be 2 negative quarters in a row. Now, it's not something that we're really impacted or feeling because the quarantine has taken over all of our mindsets and what we're dealing with. One of the things that we like to talk to everybody about is emotions and being an emotional investor and the emotions that go along with investing. So this is the roller coaster that occurs, and every market cycle goes through these same emotions. We start out on optimism. Hey, things look kind of good. Maybe I should buy in. We get excited about that. We're really piling in. Everybody's in now when it's euphoric. Like the guy down the street's making money. This guy's making money. We're euphoric. That's where the market peaks. And then as we start to go down, we start to hold. That's where we're holding out in fear and desperation. Like, no, it's going to come back. I don't want to sell yet. I'm going to hold on. That's what goes on there. And then finally, we panic and capitulation as we sell out. And that's when depression kicks in until, things look better again. I'm going to get back in. And this is what happens every single market cycle. And as investors, what we really have to try to do is to take the emotion out of the equation. And Craig, you can talk a little bit about that, about taking that emotional component out.
Sure. Yeah. I mean, I actually was talking to some clients today about their investments, and I said, how are you doing? And they said, I don't know. I'm afraid to look. And a lot of that is, like Tom has said, it's like being on a roller coaster. When you get to the top, it's okay. And then when you start heading down in that steep dive, what do? You close your eyes, you scream, you throw your hands up in the air. I don't want to look till I get to the bottom. So the thing is, when people talk about investing, they look at, well, what's the market do over time? The reason that people can't mirror the market over time is because they do become emotionally attached to their money, rightly so, and that makes them make emotional decisions. So they buy too late, they buy too late, they sell too late, and those mistakes cost them a lot of money over time. And that's why it's really important to work with somebody who can help keep you on that straight and narrow so you can take the corporate approach or the less emotional approach when it comes to investing over the long term.
Thanks, Craig. Appreciate that. So how did we get here, right? And so I might suggest if you do have a libation, I'm going to do that myself. We're going to go into a little bit of a history lesson. So, and I know sometimes this can get a little bit, glassy-eyed for some folks. We're not going to go deep into history. We're only going to stay in this century, but we're still going to go through some of it. So I am going to take a little bit of a sip here. Brace myself for this. So we're talking the pre-housing bubble, right? The man behind the curtain was Alan Greenspan. He was the then chairman of the Federal Reserve Bank. I'm not going to vilify Alan Greenspan here. That's been done enough. I will say this, in his autobiography, Greenspan himself does say that one of his biggest regrets is that he did not put the clamps down on the big banks as the housing market started to take off, right? And what that led to was a lot of these mortgages, a lot of these banks were just left unchecked. Now, nothing against Greenspan, but if you did listen to his speeches back then in the 2004, 2005 range, he was championing the idea of home ownership. That was the sign of how well the American economy was doing. Look at all the number of houses that are being bought and sold. And that was the whole mantra of his, at that time, the end of his administration. And what happened, oh, I did that. And so what happened is the mortgages spiraled out of control. Now, Greenspan leaves office in 2006, right before the bubble happens. You call that coincidence, you call it whatever you want, but that's when he leaves. And in 2007, Ben Bernanke becomes the chairman of the Federal Reserve Bank. And you can say good, bad, or indifferent about Ben Bernanke, you know, as far as how he directed this, might have been the right guy for the right time, because Bernanke was an academic whose dissertations were on the Great Depression, specifically how the Federal Reserve Bank and monetary policy could have taken different approaches and done things differently to offset some of what occurred during the Great Depression. So who better to take control of the Federal Reserve Bank than this guy when we're in the biggest decline since then, when we got into the housing collapse in 07, 08, 09. The problem is a lot of this stuff was all theory. And the first round of funding, which now we would call stimulus, so just think of stimulus, when I say TARP, just put stimulus instead of that for where we are today. But the first round of funding that they did was called TARP, which stood for Troubled Asset Relief Program. And all this was they were pushing money to the banks to buffer their bottom lines so they could then in turn lend money out. Remember, at that time, interest rates were at zero. The Fed had they've done everything they could, and you really can't go past zero. You can, we'll talk about that in a second, and that brings up the next line there, which is quantitative easing. Quantitative easing is instead of going to negative interest rates, a way for the Fed, the central bank, to go ahead and start buying back assets, issuing dollars, think stimulus again, and at the same time buying notes from corporate and other agencies. So the Fed is essentially buying and selling at the same time. And really, what that does is it makes interest rates non-existent. And it really put us in a position to say, as long as the Federal Reserve Bank is in that mode where I'm going to be lending, creating money, and buying at the same time, you can't raise interest rates. And what happens there, and what happened, is that the only place that you could get return is being in the market. And so what happens in that situation is you get this for a return. This is a chart. This is 10 years, 2007 to 2017. You can see where the collapse happened, the bottom, which was March 9th, 2009. That's a 56% decline in the S&P 500. And then where we went from there. Now, one of the things is everybody says we went straight up for 10 years. That's not entirely correct. It took almost 3.5 years to crest back to where we were. And then we ran up from there and continued to run up. An average bull market, if you're taking it from that look, runs for about 5 to 7 years. So if you do this and say, gee, sometime around 2013, we were back to even, we then ran for 5 to 7 years, 2020, and the bull market ended. So it stayed right on every single other bull market that's ever occurred. Their average length is about 5 to 7 years. But you can see there have been downturns, but every single one of these was a blip. There's a quick little blip, all of these downturns that occurred because the only place you could get return was by having money invested in the market. And the chairman of the Federal Reserve Bank, Ben Bernanke, is telling you that and saying it. And so every time there was something that occurred that could sway the markets kept going up. And they continued to go up until we ran into the pandemic. And we're in a similar situation right now because interest rates are at zero. The Federal Reserve Bank is pumping money left, right, and sideways, and they are in the process of starting to buy other type of assets through their bond buying program. So it's going to do the same thing.
Inflates the marketplace, doesn't it, Tom?
Excuse me?
That artificially inflates the marketplace, doesn't it? Because there's just nowhere else to go.
You're buoying a market without any reasoning behind it is what's going on there, and we'll talk in a couple of screens as to what happens there and where we go with that. So where are we headed? And Craig and I call this the alphabet soup theory for recovery, if you will. So every downturn, the typical market decline and recovery looks like a V, right? We go down, the one I just showed you. It went down to a bottom, it comes back up. It resembles a V when you look at it. That's a typical downturn. Sometimes they look like a U, right? And all that means is that, hey, we got down to the bottom and we ran along for a little bit, and then we came back up. COVID-19 is not either of these, okay? What you have with COVID-19 is an L, which I was kind of dismissive of in the beginning, but now I'm sort of getting closer and near to that, and I'll explain that in the next screen with the L, which is just, hey, we went down, but we don't really know what the recovery is going to look like, so we might be sliding along at this level for some period of time. And then the other one that Craig more sort of fancies than I do is the W, which is we went down, we came back up, and more than likely, because of the economic data, because of the quarantine, because of what's going on, we are probably going to go down again before we eventually come back up. And what you get is that W look with it. Okay, so that's sort of the idea, but where I see this and what Craig and I sort of gone back and forth with on is what I call the reverse square root look. And that's what this is. It's a square root, it's just reversed. But basically we go down, we come back up, and then we trail along, and you can see that first dotted line talks if everything goes well, right? Massachusetts here, we got 4 phases for opening, and that's saying that, all 4 phases, we're going to go right through them, everything's going to be fine, and we're not going to have any setbacks to that. The other dotted line sort of segues us along here with maybe there's a setback. What happens if there's another round? What happens if there's an outbreak that occurs? How does this impact us? Do we ever get to phase 4? That's where we're unsure. And that's part of what's happening here with what's going on with the markets is they don't know either. And one of the things is if you take your finger and you put it over the down spike that occurred there, right, and just block the dip that occurred, when you look at it, it looks like an L. And that's why I was saying to you is it sort of resembles that L, which is we may be right now at the point where we're going to stay at and bounce along here for the foreseeable future. But Craig and I, we don't know that. We can't tell you that because a lot of this is an unknown right now, and we're unsure where that's headed. But I can tell you this is what the market actually looks like. This is the S&P 500. Now it's through the close, earlier in the week. This was as of last Friday, but not much has changed with that. But when you look at it, there's that reverse square root, right? And there's that line starting to move along in that trench of about 28 to 2,900 that we see this possibly just meandering along for some period of time. So which brings us back to sell in May and go away, right? Which is a COVID-19 story. It's where are we headed, right? What's going to happen here? And that's what we want to talk to you a little bit about with this is what can you do? What's going on? And what are some of the things that you might be looking at or trying to do as you go forward here from this point going forward? So investing in a pandemic, it's toilet paper, right? So you didn't need toilet paper. You probably weren't even thinking about toilet paper. But one day you went to the store, or maybe you were talking to a friend who had been to the store and said, hey, it's a funny thing. Went to the store and there was no toilet paper in the aisle. And you thought, that's interesting. That's kind of weird. And then you happen to go to the store the following week and you know what? There's no toilet paper there. So now suddenly you're like, well, wait a minute. Should I be worried about this? Do I need toilet paper? And then your brain starts to go, wait, I need toilet paper. I got to get toilet paper. Where can I find toilet paper? I got to go get some toilet paper. And it's sort of the same conversation and what Craig was talking about, which is trying to keep that emotional part out of it and not to get caught up in what I like to refer to as the financial white noise that goes on out there. As I mentioned to you earlier, with the distractions of the correction and bear market explanations, most people didn't see that. And if you really didn't look at it, when you came to your statement in April, if you'd looked at your account at that time, you were probably down less than 10%. But if you were listening to the news and everything that was telling you, they were telling you that stuff was dropping all over the place. So we get caught up in that.
Yeah, I was looking for videos.
Go ahead.
I was looking for YouTube videos on how to make toilet paper, just in case.
Yeah, see, that's what's happening, right? He's out in the woods. He can start chopping down trees.
That's right.
But the other part of this that happens, right, and what the acronym that Craig and I use when we talk about this with the emotions and get involved, it's FOMO, FOMO. That's fear of missing out, right? Fear of missing out kind of looks like this, but fear of missing out is fear that I'm missing out that a downturn was happening, or the other way around. Now we bottomed, I need to buy back in. And then it becomes this roller coaster back on that whole emotional swing of should I, shouldn't I, should I, shouldn't I, should I get in, should I get out, what should I do? And it essentially looks like this. And it's never a winning way to go about it. As Craig said, you're much better off finding that steady path, trying to take what I call the motion sickness out of your portfolio and just finding that better path through this than trying to get caught up in should I sell today, should I sell tomorrow, when should I sell, what time should I sell? And it's never a winning way to look at your investments and how to handle them. So what can you do? Well, we're here in Boston, we're Patriots fans, right? So we know that the mantra is a defense always sets up the offense. So it's about having a good defensive strategy when looking at your accounts. If you are a participant in a retirement account, if you are still participating, if you're still employed, you're still able to participate in the retirement account, the first thing is to always stay in the plan because you are going to buy as all of those swings occur. You're going to buy on the way up, you're going to buy on the way down, and this is what's known as dollar cost averaging. And so staying, if you can, to participate in the plan is the first thing that you should be doing because you are buying as this goes along and bounces. It's one of those things, and I meant to say it as far as the emotional attachment. I'll talk about it in a second. I'll come back to that. I just had a different thought, but that's okay. But one of the things you can do with your retirement account, you can reassess your risk tolerance. One of the things that Craig and I will always talk to everybody about is it's always about risk. It's not about return. Somebody asked me, well, what am I going to get on this? Or what can I expect for a return for this year? Or what has it done for the last 5 years? It's irrelevant. It's more about the risk. And you've just gone through some dips and some swings and some bouncing. And it's how did that make you feel? How were you able to handle that based on where your timing is? And do you need to reassess where your risk is as far as the portfolio? That's something that you can do. And then if you're able to, right, increase your contribution amount. Now's the time to put more money in because we're down. And Craig, you had a thought on that with in terms of adding to the contribution as a way to get back up.
Yeah, I mean, a lot of times, like especially what happened in 2008. Not that this is the same situation, but people had big losses. The only way to really dig yourself out of a big loss is to reinvest when the price is down. Because like Tom was saying, is that you work it out in the end with a dollar cost averaging. So, like I said, you were buying on the way up, and as you went up, things became more expensive, and now things are on sale. So the real way to come out of a recession is to buy your way out, to be quite honest. It should not be a time when you're pulling back. It should be a time when you're throttling forward.
So that's retirement accounts. But what if you have other accounts, other investments, what in our world is known as non-qualified? That's after tax. That means it's not in a 401k or a retirement account IRA type of thing. What can you do there, right? So in that case, it's review the overall portfolio makeup. Sort of similar there in terms of assessing that, but it's really more about where am I positioned? And this can be from a macro to a micro view on that, because there are parts of the world right now that are not going to recover as quickly as some of the other parts of the world. Emerging markets, those are third world and developing nations, are not going to recover as quickly. So if you've got exposure there, it might be time to reassess that, something to look at. Real estate investment trusts, right? Usually a stable and a staple and stable investment. Rents everywhere are down, and the problem is a lot of those commercial properties are in trouble. So those are some of the things you could be looking at as far as reassessing your overall portfolio makeup. Take some profit. And you may say to yourself, wait, I'm down. How am I having profit here? But like I said, if you look at this from a year over year basis, not just the time period of the first quarter or year to date, but the S&P is up 1 year. Like I said, it's only up about 3 point something, between 3.5% and 4%. But maybe by the end of the month, it's up a little bit more. But that's still money that could be, I'm taking some profit here and I'm going to put it over here, or I'm going to put it on the sidelines for a little bit, just to take a little bit of that buffer off. Because again, nobody knows where this thing is going. Nobody. And that's the whole, we're opening in 4 phases and the quarantine and we're doing this in little baby steps because nobody knows, and specifically Wall Street has no idea where this is going to go.
Well, this particularly works if you think we're going to be hitting a W, right?
Correct. Right. Because if we're going to downturn again in the end of the month or June, then it's going to be a problem. And then again, it's always about risk. Risk is the number one thing to be assessing and looking at, to say, I'm okay where I was, but I want to make sure this goes forward, or I don't want to have as much of a downturn should we, as Craig was just alluding to, get into a second wave or have an outbreak occur, and all of a sudden, we've got to go back into quarantine again, and then everything is going to fall apart. That's what you can do as far as reassessing where you are today.
And this too, Tom, when you're talking about the emotional side of investing, is where where the emotion really does come in. It's on the risk side. So when we talk to clients about what is right or wrong for them as far as risk tolerance, it really is about what your goal is and how you're able to sleep at night. I mean, if you feel like, geez, I'm not keeping up because I'm so conservative, then you may need to be more aggressive. If you feel like, well, I'm following the market, even if you're using a benchmark, but you feel uncomfortable because you're seeing the swings in your account, and then you're too aggressive. So it really is about tailoring your portfolio both on your goals, but also on your emotional goal of how you can feel comfortable about your money over the long term as well.
Thanks, Craig. Appreciate that.
No
All right.
problem.
So last part on this is just, it's something we do with everybody and talk about all the time, which is as far as looking at where you're allocating funds. What's in my buckets, and really what you should be thinking or using your money as is having 3 sets of funds, 3 buckets, if you will. I'm a bucket guy. That's how I always allude to it. If you want pools or bags or silos, you use those. My visual is a bucket. So the first bucket is emergency reserves. This is the number one thing that we are telling everybody we talk to that you should be concentrating on. Cash in the bank, right? We should be putting funds aside if we can, to do it. One of the things with this is one of the lessons to take away and look at is to go back right now, specifically for May, and review what you spent for the first 2 months of the year, January and February, and then compare it to what you spent in March and April, because your spending habit was curtailed and very much different in March and April than it was in January and February. And the lesson is to say that lifestyle that I was leading with what I spent in March and April, can I sort of build that going forward and use those funds to start putting money in the bank? So this says usually you want to have 3 months of expenses. We're doing this more on the quarantine side. If you don't have at least 4 weeks of expenses in the bank, that should be the number one priority. The goal would be 4 to 8 weeks, sort of the quarantine effect, but to have that built up first, that should be the first place that any funds are going. Then you want to be putting money into the second bucket, which is really dedicated to I'm saving for something, whether that's a house, whether that's something else, a vacation, whatever it may be. That's the second bucket. The other part of the second bucket is this is funds that are used to pay off debt, right? I'm trying to pay down something. I'm saving for something, or I'm trying to pay off something. That should be the second bucket. And then as those fill, you move to the third bucket, which is the retirement, long-term planning. As far as retirement account is concerned, still continue to participate, but as we had said on the defensive slide, you maybe don't want to increase it if you don't have any money in the bank. If you have money in the bank, then look at, and there's outstanding debt, look to pay down the debt. If the debt's been paid down, then you increase the retirement plan. Still have the retirement plan contribution, but you want to segment how you're actually putting money out there so that you have something that is accessible should this outbreak occur again in the fall.
Yeah, because one issue you're seeing too is a lot of people in the past would use credit cards as their short-term bucket. Oh, my car broke down, or something happened with the house, or whatever the emergency need was, they go turn to their credit card or their credit line. One thing we're seeing in the COVID-19 issue here is that creditors are actually pulling back credit lines. So it kind of is starting to dry up that short-term bucket if that's the plan. So it becomes even more important to make sure that, before you start bolstering up your retirement account, like we suggested earlier, that you definitely have a savings plan for that first and second bucket.
Thanks, Greg. So what's on tap? So definitely a pun intended with this. But next week we are going to do a piece that I've been doing for a long period of time that's called FACT, which is Financial Answers in Career Transition, that has just been updated, or it's subtitled What to Do If You've Been Let Go. But in this case, it's what to do if you've been furloughed or let go due to coronavirus. We've updated it for the CARES Act and some other parts that go along with it, but it's a presentation I've been doing for a long period of time that we've altered and changed. That'll be next Thursday. And then we're doing saving versus spending in a pandemic, what that looks like and how it sort of compares with the US economy. And then in June 11th, we're doing how to save, and that's not for college, that's on college, because let's face it, nobody is able to save for college with the average expense of somewhere in the $27,000 range across an average the US per year. So it's more of how can we help lower those expenses when we are looking at college. But those are the ones that are coming up. These are going to be every Thursday at 4:30. So some FAQs, there's some facts out there. How do I contact you? We got that on the next screen, which will touch some of that. What does it cost for a workshop? If you visit our site, we do workshops for organizations, for employees of businesses to come in and do some of this on budget, cash flow, retirement savings, anything that's a topic of concern. We're a nonprofit. There is no cost. We do this as an educational outreach, so there's never a cost, there's never an obligation for any of the workshops that we do. Can we work with you on your investments or financial plan? The answer is yes, but not under Aries. Craig and I have a side gig that we do. We are actually investment advisors and financial planners. And so the SEC, FINRA, our governing body, says we have to put on a different hat. If you want to work with us, it's fine. We can schedule a time to do that, but we do have to put a different hat on to do that, which puts us under the regulatory authorities that govern that. That's just the disclosures in terms of how that all works. This is the information. There's the email, info@aresfoundation.org. The phone number is 617-431-5045. That's a direct line. You'll get me on the line if you have a question or concern, and happy to try to help you out. With that, I am going to close this down and then see if there were any questions, but I got us at about 5:15. We don't want to go more than 45 minutes with these. That's the whole idea with this. So if you do have any questions, feel free. Like I said, you can shoot us an email, go to the site, check us out. There's a contact us on the website as well. But anytime you have any questions, always feel free just to chime in and just to ask.
There's also the chat box if anybody wants to ask a question as well.
And with that, I am going to stop the screen share and end the presentation. I certainly appreciate it. I hope you all have a wonderful evening. Thank you very much, and stay safe.
Thank you for attending.
And
Ooh, we have a question.
oh,
Oh, thank you, Tom and Craig.
yeah.
You're welcome.